Hello
Okay.
and welcome back to our weekly market recap. I'm with Rich
Hello, everyone.
and I'm Knight. Let's get to it. So this past week, we saw the market down around 4.5%, which brings it down year to date 5.9%, down from the highs in February 10.3%, but up from the lows in March still 34.4%. So we saw some bad news affect the market, especially midweek on Thursday, and it's mainly centered around the Fed and their guidance for the economy and a second potential wave or first wave of cases increasing. So, Rich, do you want to speak briefly
Yes,
about the new cases we saw?
yes, I do. So what we're seeing is what to be expected, which was that on several of the states that have opened up, we're now seeing spikes in the coronavirus, especially in California, Arizona, the two Carolinas. As a result, this is and the fear is that the economies will shut down again. None of the governors have done that so far, which is one of the reasons why we saw the market going up today.
Yeah, and I guess one of the questions on people's mind is, uh, have we seen, we know that the protests were happening kind of this past week. That's been a lot of people interacting. The coronavirus new cases lags about 2 weeks. In a couple weeks from now, are we going to see some major spikes specifically in California and some of those other states?
I would expect that. What we're seeing now are spikes that are probably more related to things having been opened up around Memorial Day, because that's about 2 weeks ago, a little bit more. And if we remember from the initial outbreak, it started slow and then it built up, and it took about a month before we saw the top of those spikes.
Gotcha. Well, thank you. And then the other big news that affected the market actually the same day, which is why we saw a 6% drop on Thursday, was the Fed released their notes. And one of the main kind of shockers is that they're expecting to keep interest rates at zero for the next 2 years. So what does that signal? That basically signals to the market that they're expecting unemployment to remain high. I think they said the mid to high nines throughout 2021. That is obviously drastically different than what the market was initially pricing in, which was this great V-shaped recovery based off the news that we heard from hirings in May. And so it looks like what the Fed is expecting is a second wave of this and to this continued economic pain, not just through 2020, but also through 2021. And like I said, both these happened on the same day, and it's why we saw such a sell-off in the market. Now, what's not uncommon to see is after a major day of sell-offs, we saw the next day the markets rise. So, Rich, you want to speak briefly about that?
Some of this is, yes, some of this is bargain hunting. Some of it is just a reaction that people believe there was an oversell, which usually happens. And if you really look at it, the market drops approximately 6% on Thursday, and it rose 2% on Friday. That's not a big rise compared to what was dropped. So I'm not unexpected to see more volatility coming for next week.
Yeah, I think that's some great guidance. And, as with everything, your portfolios are built for volatility. As we see increased volatility, if there are certain emotions that are coming up for you, please let us know. We're still here to support you. Your money is, again, built to support you. And we hope you have a great rest of your weekend. Thanks for spending some time with us.